Hello, this is Mike Swanson of WallStreetWindow.com. We're entering the month of July, and we got to get ready because I see signs that the stock market is changing, and we're about to see some big swings that are going to take people by surprise because we're not used to big swings anymore in the market because it's barely been moving on an intraday basis. Now, as I load up the presentation to show you what I'm seeing, if you would like this video, so that I know that you're there. Now, take a look at this. This is the S&P 500 and the number of 1% down days we've had and the number of 1% up days going back to 1928. Now, what's remarkable about this year is that in 2017, there's only been two 1% down days and two 1% up days, which is historic. If that were to continue, it would be the first time that's ever, in fact, happened. Last year, there are 20 such days where the market went down 1% and 26 days in which it went up 1%. So for this level of, stock market slowness and barely moving, it's basically unprecedented. You got to go back to 1964 to find a time in which the market didn't even go up 1% or more in a single day that entire year. It fell 3 times that more. Now, this is going to change, and we're going to see more big swings in the market, I think, starting this month. Now, you got to understand why I'm saying this to get a good grasp of what direction these swings are going to be in and what's likely to happen so we can adapt with our trading tactics. Now, first of all, one of the key things that's happened this year in the financial markets is that there have been 5 stocks that have led the market higher, in particularly the S&P 500 and the Nasdaq. 5 stocks have contributed to 40% of the gains so far this year because these 5 stocks weigh the averages so much by going up so much. And this is the Wall Street Journal, and these 5 stocks, of course, are Apple, Facebook, Amazon, Microsoft, Google. Now, this article was done April 25th, and interesting enough, in May, many of these stocks even went up even higher. And I actually see about 24 more stocks outside these 5 that are also critical market leaders that also exploded higher in May. Stocks such as Nvidia being the most famous one. They went parabolic in May and made peaks and have come down a little bit since then. But from a historic standpoint, this is really important for the way markets trade, because when you see a small number of stocks contribute to create most of the gains in the market, the leadership of the market narrows, and that's typically what you see towards the end of a bull market cycle. This happened in 2007 and in the late 1999 and the first few months of 2000. This Wall Street Journal article talks about this historic thing. Now, what was interesting, though, is in 2000, from January the 1st to March the 10th, when the market peaked out and that bull market ended, it was actually 10 stocks that equaled 40% of the index gains for the Nasdaq. This time it's 5. Now, people who know stock market history going back further than that, and if you do, you may be familiar with the term Nifty 50. That was part of the 60s and the 1970s, the end of the 60s, early 1970s. That was 50 blue chip stocks on the New York Stock Exchange that made most of those gains. Now, the troubling aspect of these trends is that when you see these stocks top out, these market leaders top out, which happened in the 70s, which happened in March 2000, which also happened in October 2000. It was a couple stocks then too. Typically what happens is these stocks in the next couple years become horrible stock market laggards. So in the 1970s, there was a bear market for the Dow, which it fell 48% during the Watergate era, actually. But these 50 stocks fell even more for nightmare declines. The same thing happened in the technology bubble bust of 2000, and also leaders that got killed in 2008. The Nasdaq right now, this is the Nasdaq for the past year, and starting in February, of course, it began this big rally that we're also familiar with today, in which people have seen the market have no volatility this year, not even a 1%, just two 1% down days for S&P 500 that were quickly forgotten about. Now, what's interesting is that since the election of Donald Trump, the Dow broke 20,000, and the 50-day moving average for the Nasdaq, and the other two averages too for that matter, has acted as firm support every time, and that's the blue line here, every time the Nasdaq would hit the 50-day moving average, it would quickly go back up. It has not spent more than 2 days below it since last week, in which it spent several days below it and did the same thing on Monday. So that is a break of support that has occurred. Importantly, though, in May, there was a virtual blast off in many of the leaders. Nvidia almost went up 50%. But then on June the 9th, there was a key reversal day for these leaders, and they plunged, and they've been trending down ever since. And if we look at these stocks, these 5 market leaders, all of them have been weakening since June the 9th, and now they're down below their 50-day moving average. Decisively, in the case of Apple here, it's been below the 50-day moving average now for over 2 weeks, since June the 9th, in fact. The next support level is really somewhere in the range of the 150 and 200-day moving average, the 130 to 135 area. If you just look at Apple, it seems very likely it's going to fall to that level in the next couple of weeks. Similar trend with Facebook. You can see how the 50-day moving average for Facebook was support this year in April, in May, in June, and now we're below it again. Facebook is actually one of the stronger of these stocks still, one of the stronger market leaders, but it too fell 1.69% on Monday, which it's interesting that these stocks all fell on Monday because the Dow was up substantially. It went up almost 200 points intraday in the shortened session, while these stocks finished in the red, a sign of relative weakness in regards to the rest of the stock market. Amazon, same thing. It was down 1.48% on Monday. It also reversed on June the 9th. It then made a minor new high, quickly was unable to break that and went down. These stocks actually sort of have similar trading patterns that they did in October when they dipped into November. So at the very least, I think we're in a position where you can expect a dip like we saw in September, October, November for these stocks, a retest of the moving averages. Microsoft is also trading weaker. It actually is one of the weakest of these 5 stocks. Seems almost destined now to go to the 64 level. Google is down already over 5% from the high. It's gone much lower than the 50-day moving average now, really damaged. The thing is, though, outside these stocks, other leading stocks, and I'll pull up Nvidia. I'm not going to go through all of them, but Nvidia also had that key reversal day, June the 9th. Not yet below the 50-day moving average, but it basically looks like it's done. More importantly, though, Nvidia went from 100 up to 170. And if you look at the chart in Nvidia for the past couple of years, it tells a remarkable story. This is a stock that has gone up substantially of years, and it went from $20 up to 100 in 2 years, then from 100 to 170 in just a few weeks, where it peaked out in June the 9th. Well, when you see stocks go up parabolic like this, generally speaking, you can expect a correction or at least a consolidation period of several months before a new move higher. And that's what these stocks all look like they're telling me. So the upside in these stocks in the short term is very limited, and that means the risks are way to the downside. Very likely we're going to see them test the 200-day moving averages. And this could be the makings of a substantial topping process in the stock markets that will lead to a bigger drop in the fall. But at the very least, we do seem to be destined for a bout of volatility in the markets, a corrective phase, let's say the next 6 weeks. And then we'll have to analyze things and see, is there panic in the markets? It's all kinds of different factors to determine whether that's going to be a simple correction that's going to lead to a higher rally, or the top of a very substantial topping phase in the market that's going to lead to an even bigger drop in the fall. That's a lesson, or that's a judgment to make later. The key factor I want to tell you now, though, is stock market volatility is coming, and that's something we're not used to at all. We can measure that in the S&P 500 with two indicators I have on this chart. The top indicator is the width of the 20-day Bollinger Bands that measure the intraday price volatility on the S&P 500. These bands get narrow when the volatility shrinks. And historically, when that happens and these bands actually touch, there's an expansion of volatility. That simply means that the prices have been in a trading range that compresses the band, and that trading range then expands either up or down. You get a breakout or a breakdown that lasts at least a week to cause the bands to expand. Now, historically, this does lead to big moves, but since July of last year, something interesting began to happen, which I'd never seen in the over 20 years I've been trading in the financial markets. And that is that these bands touched, and instead of immediately beginning to expand, they would then drift and remain narrow for a week or two before expanding. Something very unusual. And the Bollinger Band width indicator above measures the width of the bands, and I circled the last two times they got below 2, as low as they are now, which in August last year, they never gotten this low before. So, well, not in the years I've been trading. You had to go back to 1993 to find that, and they stayed that way. And then, of course, we got a minor correction. The market did dip in September following that August compression and volatility that led to a small corrective phase, a retest of the 200-day moving average for the markets into the Trump election. And then we got a resumption of the rally. And then we had another compression in January that led to a breakout. And now we're experiencing another compression. Really, we have been seeing this compression now for almost 2 weeks. It took 3 weeks to break out of that phase in August and January. We're now 2 weeks into it. So we're on the edge of, just by looking at this indicator, a move up or down. That's all this indicator is telling us. A move up or down is going to come soon. That should last at least a week. A breakout of the range. Resistance is 2450. Support is basically 2420, essentially, for the S&P 500. Now, I think the move is going to be down because of the drop and already break of support that we've seen in these stock leaders in the technology space. The Nasdaq itself has broken the 50-day moving average. Support for the Nasdaq is at 6,100. So if we close below 6,100, that's been the May June support. really the June support. If it closed below 6,100, then the warning signal given in the weakness of these tech stocks and the close below the 50-day moving average, in my estimate, in my book, will be confirmed, and we can expect to move lower during the course of the next couple of weeks to retest the moving averages. Now, another indicator that's also measures volatility is the VIX. That's the implied volatility in the options market, what people are actually paying for volatility. A lot of people use options to hedge their portfolios. When the VIX goes up, they become more scared of volatility, more scared of market drops. And what's happened this year is the VIX has traded in for an historically low amount of time below 13, basically. If you go back to the 1970s, the VIX usually trades over 13, somewhere around 14 and 15. But we've been below that level because no one is really worried about volatility in the markets, as we've basically fallen asleep because of the lack of market moves on a daily basis. Well, this is going to change, and the VIX is likely to trend up now. And when the VIX trends up, typically that happens during stock market corrections or declines too. Now, that's what I think is coming. And the thing is, we really need to prepare for that. The market indicators are telling us volatility is coming. We can expect some big swings to take place over the next 6 weeks. And I want to help you prepare for that, not just mentally, but tactically. So on Sunday at 8 p.m., I'm going to do another video presentation, which we can think about this more and lay out some guidelines on how we need to adapt and adjust, because everyone is asleep right now. The market has lulled everyone to sleep because it hasn't been moving for 7 months, more than 1% in a given day, except 4 days. And it hasn't fallen at all. So people aren't ready. In fact, there's been built up a record amount of margin debt too. So we're going to get ready. And at 8 p.m. Eastern Standard Time, I'm going to do a video as a second part of this presentation. So to get that video, if you're watching on YouTube, subscribe to the YouTube channel. If you're coming to my website, or if you're on YouTube too, get on my free email list, and I'll send you the email notification for when this video gets out. You might want to check the last video I did above too, and I'll be talking with you later.